Hey everyone! Imagine you are holding an investment that promises an 11.5% yearly payout. It is marketed to you as a safe, steady income stream, something designed to always trade right around $100 a share. It sounds like the ultimate financial cheat code. But then, almost overnight, the price drops by over 12%. Suddenly, that safe haven is trading at $88, your capital is shrinking, and the internet is flooded with rumors that the whole system is collapsing. This is exactly what is happening right now to everyday investors who bought into Michael Saylor's grand financial experiment. If you track the crypto world, you know that MicroStrategy, which we will just call Strategy for this story, is less of a software company these days and more of a massive institutional Bitcoin vault. Led by its chairman and legendary Bitcoin bull, Michael Saylor, the company has hoarded an astonishing 847,000 Bitcoins. To put that in perspective, that is roughly 4% of the entire global supply of Bitcoin that will ever exist. It is a staggering amount of digital gold, currently worth well over $50 billion. But how exactly does a company buy $50 billion worth of Bitcoin without actually making billions of dollars in profit from its day-to-day software business? The answer lies in a masterclass of financial engineering. For years, Saylor has been funding this massive Bitcoin shopping spree by selling common stock and issuing billions of dollars in corporate debt. But over the past year, Strategy turned to a new, much more aggressive weapon in its financial arsenal: preferred stock. Specifically, a massive $9 billion issue of variable-rate preferred stock known on the market as STRC, trading under the ticker STRC. Now, if you are not a Wall Street analyst, preferred stock can sound a bit complicated. Think of it as a hybrid between a regular stock and a bond. It is a senior form of equity, meaning if things go sideways, preferred shareholders get paid before common stockholders do. But unlike a regular corporate bond, if a company runs low on cash, it can actually pause or suspend preferred dividend payments without triggering a legal bankruptcy or default. Traditionally, this is a market dominated by massive institutions, banks, hedge funds, and pension funds, big players who buy in blocks of tens of millions of dollars. But Strategy did something completely different. They cultivated an intensely loyal base of everyday retail investors. The exact same everyday people who buy their common stock were targeted to buy this preferred stock. In fact, Wall Street analysts estimate that a staggering 80% of this $9 billion STRC preferred stock is held not by massive hedge funds, but by retail buyers. Everyday people looking for steady yield. To reach these people, Strategy launched a massive, highly aggressive advertising campaign on social media platforms like X. One of their most famous ads was explicitly modeled after the hit HBO show Industry. Picture a chaotic, high-stakes Wall Street trading desk. The head of the desk is pacing around, literally swinging a baseball bat, demanding that his team bring him high-income investment ideas. One by one, the traders pitch options, but they all get shot down. Then, someone brings up STRC. The boss stops. He hears about the massive, tax-deferred double-digit yield, and he is sold. He looks at the camera and says, "All of our customers would want that. STRC is for everyone." It was a brilliant piece of marketing, and for a long time, the machine worked perfectly. The STRC preferred stock was engineered to trade right near its face value of $100 per share. To keep it there, Strategy operates on a variable rate system, adjusting the dividend payout every single month. Right now, it is paying out an incredible 11.5% on that $100 face value. If the market starts demanding a higher return, Strategy simply bumps up the dividend yield to make the stock more attractive, keeping the price stable at $100. For most of 2026, this grand design functioned exactly as planned. In late May, it was trading right at that $100 target. By mid-June, it slipped slightly to $95, but then the wheels began to wobble. In late June, the price of STRC crashed down to $88 a share. A 12% drop below its face value might not sound like a total catastrophe for a regular stock, but for a security designed to act like a steady, stable store of value, a double-digit drop below par value is a massive red flag. Because the price fell so low, its current yield actually spiked to an eye-watering 13%. When an investment's yield spikes that high, it usually means one thing: The market is pricing in serious risk. Almost immediately, panic began to spread across financial social media. Traders and crypto enthusiasts started throwing around a terrifying word. They claimed that Stretch had depegged. Now, in the crypto universe, depegging is a word that triggers absolute post-traumatic stress. It is a direct reference to algorithmic stablecoins like Terra USD, which were mathematically guaranteed to stay pinned to exactly $1, only to completely collapse to zero overnight, wiping out tens of billions of dollars of investor wealth. Wall Street analysts immediately rushed to calm the waters. Mark Palmer, a prominent analyst from Benchmark, issued a note to clients stating that the entire depegging narrative was a massive misperception. A stablecoin has a legal and mathematical obligation to maintain a fixed exchange relationship with the dollar. Strategy's Stretch stock has no such obligation. Strategy's goal was always to support the trading price near $100 through dividend adjustments, not to guarantee it like a currency. So, if it wasn't a structural stablecoin failure, why did the price collapse so rapidly? The answer comes down to a brutal cocktail of retail panic and forced leverage liquidation. Remember, 80% of these shares are owned by retail investors. When the price of Bitcoin took a 3% hit on a Tuesday, sliding down to around $62,000, marking a nearly 20% drop over the course of just a single month, retail investors got spooked. But the real damage came from leverage. A significant number of these everyday investors hadn't just bought the preferred stock with their own cash. They had borrowed money against their Stretch holdings to buy even more, attempting to amplify that already high 11.5% return. When the price of Stretch started dipping in early June, those brokerage accounts hit a wall. The falling price triggered massive margin requirements. Suddenly, these investors were forced to either inject more cash into their accounts immediately or have their positions forcibly sold off by the brokers. They didn't have the cash. The resulting margin calls triggered a vicious cascade of automated selling, dumping massive blocks of Stretch onto the market all at once, driving the price down to that $88 low. This brings us to the core, fundamental paradox of Michael Saylor's strategy, a dilemma that has institutional short sellers and conservative investors asking hard questions. Strategy currently has about $15 billion of preferred stock outstanding, with Stretch accounting for $9 billion of that total. To pay the dividends on all that preferred stock, Strategy has to cough up a staggering $1.7 billion in cash every single year. But here is the catch. Strategy is using the money it raises from these stock sales to buy Bitcoin. And Bitcoin, by its very nature, produces exactly zero cash flow. It doesn't pay a dividend. It doesn't generate monthly income. It just sits in a digital vault. To make matters worse, Strategy's core software business doesn't generate anywhere near enough operating earnings to cover a $1.7 billion annual dividend obligation. The company doesn't even pay a dividend to its common stock owners. So, how do you pay $1.7 billion a year in dividends when your primary asset generates zero income? Up until now, Strategy has relied almost entirely on a continuous loop of financial engineering. They sell more common stock to raise cash, and then use that cash to pay the dividends on the preferred stock. It is a system that works beautifully when the market is booming, your stock price is soaring, and everyone is hungry for Bitcoin exposure. But it creates a highly fragile ecosystem when the market turns sour. Strategy tried to soothe the market's anxiety by announcing that they had sold a block of common stock to boost their corporate cash reserves by $300 million, bringing their total cash pile to $1.4 billion. On paper, that sounds great. It means they have about 10 months of dividend coverage tucked away safely in the bank. But the market saw right through it. Despite that massive announcement on a Monday, the price of Stretch continued to weaken into Tuesday. The market is realizing that a 10-month runway is just a temporary band-aid if the underlying asset class enters a prolonged crypto winter. Ultimately, the absolute final backstop for Strategy's multi-billion-dollar dividend obligation is the Bitcoin itself. If things get truly desperate, the company could theoretically sell off portions of its 847,000 Bitcoin stash to meet its cash flow demands. But Michael Saylor has made it a core point of his corporate identity that Strategy will never sell its Bitcoin willingly. He views Bitcoin as the ultimate apex property. Furthermore, If Strategy were ever forced to liquidate a sizable portion of its Bitcoin holdings to pay preferred dividends, that mass selling pressure could severely depress the global price of Bitcoin, creating a disastrous feedback loop that hits their own balance sheet. Because these preferred shares are perpetual, Strategy is under no legal obligation to ever repay the principal $100 per share to investors. They don't have to give the money back. They just have to keep finding a way to pay that dividend. Rumors suggest the company might raise the dividend rate from 11.5% to 12% by the end of the month to try and lure buyers back and force the stock price back up to $100. But analysts are highly skeptical that a mere 0.5% bump will be enough to reverse the damage caused by the margin call cascade. The entire thesis of Saylor's strategy relies on a simple, singular belief that over the long term, Bitcoin will appreciate at a rate that is significantly faster than the double-digit dividend cost of the preferred stock. If Bitcoin skyrockets, issuing preferred stock to buy it looks like a stroke of absolute genius. It creates massive, unreplicable value for common shareholders. But right now, for the first time in a long time, that thesis is facing a brutal reality check. Bitcoin has dropped significantly from its recent highs. The common stock of Strategy has plunged 70% over the past year, from its peak of $450 down to $106, and the dividend obligations are compounding by the day. What started as a revolutionary way for retail investors to capture institutional-grade yield has suddenly transformed into a high-stakes waiting game, leaving everyday investors trapped in an $88 hole, wondering if the man who owns 4% of the world's Bitcoin can pull off one more financial miracle. This is not financial advice.